because you're about to hear a bunch of it. No, I'm just kidding. So there's a phrase in stand-up comedy called the check spot, which is, it's the last set of a comedy show where everyone gets the checks from the waiters and waitresses. So that's what we have. We got the check spot, but we're gonna try and have fun with it. So if you're wondering who this guy is making bad jokes, my name is Dan Marcus. I'm a founder originally, so I started several companies, largely in sports technology. Went on from there to get a law degree at the behest of my very pushy Jewish mother, and ended up becoming a lawyer, so that's my day-to-day. I have my own practice. I represent family offices, as well as a bunch of early to mid-stage companies across a bunch of sectors, including sports, entertainment, technology, et cetera. And then the one thing you'll actually hear or see on the agenda here, I'm also a professor at NYU in their sports business program. I'm not an academic, but I play one on TV. So without further ado, I'm gonna let everyone on this panel introduce themselves. From my left, your right, starting with Sal Buscemi. So who are you? What do you do? And what's a fun fact about you?
You guys hear me? Is this on? No?
Yeah.
Try the other mic.
Try the other mic.
We're gonna swap them out. I think there's a battery.
All right, this one's not working either.
Did you turn it off? How do they run out of battery and?
Always that how it breaks everything.
Hey! There we go. We got it. Okay.
Hey, my name is Sal Buscemi. I manage a multifamily office called HRN. And we've made tremendous investments into earlier stage technology and life science companies because of the network that myself and my two partners have in that space. We right now have gotten into about 12 names. My background is originally distressed real estate at Goldman Sachs back in the late 90s. At the age of 29, I raised $30 million from a Park Avenue investment manager named Medley Capital, and we basically became the kitchen sink for Bear Stearns, and that was my first foray into managing my own balance sheet for the past 20 years. And since then, we've been involved in several names that you might have heard here from Marty, such as Thrive Bioscience, we have a significant investment into that. Also, we've worked in some higher profile things such as Stripe, which we're working on right now, and also another slug of SpaceX. So that's where I'm based in Miami, and I just walked across the street today to see you guys.
Are you related to Steve Buscemi?
He's my second cousin, and I have stories for later on that.
Oh, is that a fact?
That is it.
Okay, that's awesome. I was not expecting a yes.
23andMe stat. Yes, absolutely. I haven't seen him in 30 years, but I got plenty of stories.
Okay, all right. Everyone put a bookmark in that one. Go ahead.
Name is Marco Soriano, also come from Goldman Sachs. Thank God I never share offices with this guy. But about at the same time we're there. I was in the automotive sector representing Fiat Chrysler back in 2005, if you all recall that. 22.5 billion later. I'm running my own practice with my own family. Comes also from the automotive sector since 1903. France, Spain, and today Italy. So we're back in business.
Good afternoon, I'm Rick Stone. I have my own family office. And then I also run a group called Palm Beach Investment Research Group, which is a group of 37 family offices, mostly from Miami up to Jupiter, Florida. And we meet twice a month to vet investment ideas. We invest individually, not collectively, but we share the due diligence process, we share ideas. And we think that collective process really enhances the ability for people to invest. I'm also a lawyer by training, and I do securities law and securities class actions.
My name is Chris Anci. For the last 8 years, I've been working for a multi-billion-dollar family in New York City, basically providing non-correlated private equity investments for that family, usually Series A, post-revenue. We found out pretty early that pre-revenue was not his temperament at all. Ironic because it was a real estate family in business for 107 years, but waiting for revenue was too much for him. Prior to that, I ran my own broker-dealer for about 17 years, and that was a trading shop and also a fund administration company. So looking forward to the discussion today.
Before we get into it, Marco, did you have an announcement? Are we being broadcast into the metaverse? Is that something that's happening?
Yes.
Your guy was on, he's online.
Yeah,
Let me give him rights.
Yeah, co-host so that he can see basically what we're doing in telecommunications, EVs, metaverse, AI, all in one shot. It's gonna be presented in the background as we speak.
Yeah, you guys have all unwittingly consented to be
Oh my
broadcast
gosh.
into the metaverse. So
Look at this guy.
hopefully you can deal with that.
There it is.
Votes.
Oh, that's me? No, that can't be me. So let's get into the serious portion of the discussion, which is, I feel like for the last, call it 12 to 18 months, we've lived in a macroeconomically uncertain and some would argue tense time. And I think one of the things that money can buy you, among other things, is options, right? And freedom and choice. And so running a family office, managing a family office, you have a lot of choice as far as where you can allocate your capital and when you can allocate your capital and how. So how has, and I'll start with you, Sal, just sort of go logistically here, left to right. How has the macro affected your interest in doing deals in general? And if so, in what way?
I think there's still a lot of money doing deals out there right now. They're going into quality names. And the reason why we've had a tremendous amount of success is because when we're investing in a venture, we have two rules. And if you violate these two rules, then you're a factory pilot, right? You're flying without any sort of understanding what that aircraft can do. Number one is we only bet on pedigree founders who have had multiple exits. If they haven't had multiple exits, we don't want to talk to them. This is the world today that you bet on the jockeys, not the horses. And we saw that with Silicon Valley Bank, and a lot of people just went out of business with that. And the second one is something that, a rule that I made up, but I think the cap table is absolutely the soul of the asset or the company. And if you have a cap table with large in-kind families who have invested into these direct private investments, these companies, I'm talking about Thrive, Marty, for example, it has a tremendous amount of security, but also a different degree of certainty of execution, that you have a founder who's had families back to before and other successful endeavors that are ready to bet on him again too. And be able to find those deals really takes a tremendous amount of reputation to do what you say you're going to do and to put the money into these things. So, it's going over quality right now. And I think, a lot of the speculative things, especially since I moved to Miami a year ago before Silicon Valley Bank blew up, there are a lot of founders raising a lot of money, but there's not anyone in this room would probably invest into, because they were just too green, they were too new, they were too immature. They never had an exit before, and they were sort of grasping, for straws trying to get to that point. So the money's dried up, and I think with interest rates that have gone up now, people are looking at different things rather than speculating on, earlier stage deals with first-time founders. Marco?
What was the question?
The question is,
You lost me.
I know the question, but your confused face may be confused, so don't do the confused face. Thank you. So the question was, given the macroeconomically uncertain times, has that affected your interest in doing deals and the type of deals that you do? Yeah, that was the question.
All right, so anytime that we've seen any economic downturns, any pandemics, any distress or crisis, whatever, that's the opportunity to go with. And I always look for that, specifically for that. So for example, and something that we're seeing is during this pandemic, a lot of the manufacturing around the world got shut down. Suppliers were shut down, containers, freight, everything got shut down. So how were these businesses able to continue approaching the clients or going through a prototype phase into a production phase is part of the reason that this whole thing of digital and virtual world grew. So we're looking into replacing, communicating with our clients or pre-prototype phase, allowing the market just to give us enormous feedback, which is a lot less expensive and more time efficient to get to market with new products. So that basically is what we're doing.
So you saw opportunity when there was a downturn.
Always.
Okay, and so let's be specific. What kind of deals are you? Are we looking at one right now? Are we in the middle of one?
So this is a replica, it's a 3D replica of our manufacturing plant located in Monza, which is near the Grand Prix Monza F1, as we are being part of the FIA and all the ESG frameworks that places like Monaco have started. So here we have a manufacturing plant in the middle of the country, and we're able to showcase internally basically all of the products that we're prototyping, producing in the next 10 years. And the market tells us if they're feasible and viable for the clients that are looking at it, including the fashion. So you see like the avatar, people that can communicate directly with you on a 24/7 basis. And this is where the AI plays a role. Because the AI, when you're sleeping, something should be communicating with your client 24/7, 365 days out of the year.
There's no Grand Theft Auto in this metaverse, is there?
Not yet, but it's something that definitely the gamification of your business, if you're targeting the consumers of the future, should be addressed, and not too many people are thinking about it. Everybody's still thinking traditionally, and that's not traditionally your client anymore.
Gotcha.
So our position is, unfortunately, macro doesn't matter. The only thing that matters is interest rates and perspective on interest rates. We've been through a multi-year war in Russia, which we thought would raise oil prices and didn't. We're through a large conflict that will take another 9 months to a year to begin to resolve in the Middle East. We have a new alignment of power between Russia, China, North Korea, Iran. That's really a 2-year creation. And then none of that has derailed the market. The market is fixated continuously on basis points. I went to Columbia Business School, and I don't remember the word basis points ever being mentioned once. I'm older than some of the people in the room here, but that's a fact. So to watch Bloomberg every morning and find out that we had a 2 basis point move in the 10-year, and people are concerned about that, is somewhat shocking to me. The only macro factor that we think is investable is that interest rates have gone up. And private lending, middle market lending that was yielding 9 to 11 is now yielding 13 to 16. And that's the space where we've gone in deep with seasoned managers, with new loans. And we think that will pay off handsomely in the future. We actually think private debt will be a better investment than private equity. That's our opinion.
Last but not least, Chris.
I can't disagree more in terms of the factor that interest rates matter. I don't want to wax too philosophical on what I call the Fed's counterfeiting ring for the last 15 to 20 years, but it's going to be a very interesting cycle watching these young startup companies try to navigate the world in normalized interest rates. As we all know, it used to be shirt sleeves of shirt sleeves in 3 generations, and everybody got an extra 2 generations out of it because they got bailed out on their assets. So I think you're going to have to really watch your private portfolio companies. I think you're going to be probably waiting for liquidity. There probably won't be an M&A cycle until probably late 24, depending on the election, if not 25, before some of the players come in. So that's going to be a little bit of a dicey time. When you're looking at family offices, now they're starting to realize that over the last number of years, they've put so much money into privates, and it's not marginable, and it's primarily not lendable, and now they're sitting here and they can't get out. So what you're starting to see is a big trend towards co-invest. A lot of guys are putting some money into funds or putting a token amount into the fund, and then they're able to go into the co-invest, because then they're not locked up for 7 to 10 years in a fund, and they can realize some gains. In terms of the macro environment, the thing that concerns me particularly is when US debt went from 10 to 15 trillion, that was a pretty big move, but the delta between 34 trillion and 40 trillion is 2 years away. And if you're in a world of interest rates like this, you're going to have upwards of $1.5 trillion or higher in terms of annual interest payments by our government. So they're going to get it either 2 ways. They're either going to raise taxes or they're going to inflate it all away. So I think everybody needs to start thinking along the lines of a fortress balance sheet, because this upside down pyramid could get a little bit, unbalanced.
Okay, a lot of optimism in that. So Chris, as the cynic, or the token cynic, or whatever you want to call it on the panel, a lot of people here have talked on the panel and just in general throughout the course of 2 days have talked about quality and being able to vet quality deals and bad deals. In your experience, one, how do you do that? I think every family office probably has a different approach. Like, who do you trust? What do you look at as indices of potential success? And is that easier in a market like this?
It's interesting that after each kind of financial crisis, the guys that caused it actually create the rules that benefit them. So then they end up amassing more. So when you get into environments like this, people are going to gravitate to quote unquote quality names, and then they're going to end up getting more and more client share. So unbalanced markets aren't good either, right? If Blackstone, BlackRock, and all these guys have all the dough, I mean, I don't really think that's, good for the overall economy. But